This is level 1 of the CFA program, the topic on fixed income markets, and the reading on issuance, trading, and funding. This is a second reading in this topic area. In fact, it's a second descriptive reading. Let me just remind you that in that first reading, we laid the foundation with lots of bricks. We did lots of definitions. We asked the questions, who borrows money in the bond market? What are the proceeds of those bond issues used for? And what do bondholders get out of investing in corporate or government bonds? In this reading, we're going to extend that question to include something that sounds like, hey, how in fact does the mechanics of a bond market work? So that's where we get the issuance, the trading, and the funding. And so it's really a simple matter of someone like James Johnson from Johnson & Johnson waking up in the morning and saying, hey, I have a new great idea for a first aid kit. I need $500 million. In this reading, we're going to address the answers to that question of how, in fact, will James Johnson have access to capital markets, raise the capital quickly, and then be able to invest in that wealth increasing project. By the way, those of you who are history buffs will know that James Johnson and his brothers, they developed the first aid kit back in, 1880 or something, because they were on a train and someone was bleeding on the train, I guess. So let's go ahead and look at these learning outcome statements. And you guys who watch my videos will know that, I have kind of a silly way that my brain works. I'm pretty certain that in all of the years of looking at the CFA program, this is the first time that the action word is just describe. And so if you look at Bloom's taxonomy, describe falls under the heading of understanding, and it asks you to explain a concept or an idea. So remember, we're going to describe all this stuff. And really, these LOSs are based on the simple fact of how do we get capital from the investing public into the hands, and how about this one, into the most efficient hands, so that those hands can use those for wealth increasing projects. Now that, of course, is for corporate bonds. With government bonds, you could make the argument that that they're not really wealth increasing, but they're increasing something. I don't know really what that is sometimes. So let's look at some of these. That first one is important, classification of fixed income markets. And then notice the third one there. There's mechanics. I used that word earlier, mechanically. How are we mechanically going to get the capital from me to James Johnson? We'll talk about primary market, secondary market, and all different types of bonds, which we did in that previous reading. And then we'll end with a short conversation on some structured financial instruments and then some repurchase agreements. So let's do this simple one first. And this is probably really good material for an exam question. I can envision the institute giving you a question stem in which they say something like, hey, here's somebody, maybe it's an individual, maybe it's an institution, and they're going to either issue a bond or buy a bond, and here are the characteristics. So let's go ahead and classify fixed income markets according to type of user. And so we know that corporations issue bonds, we know that governments issue bonds, and we know that households, non-financial corporations and governments and financial institutions, they can all buy bonds as well. We can classify them either by their level of default risk, which is, if you remember our conversations about Moody's and Standard & Poor's and Fitch, anything that's triple B rated or above is known as investment grade. Double B rated or below is known as non-investment grade. So creditworthiness, think about that in terms of default risk. And then by maturity, think of that in terms of interest rate risk. So of course, these can be short term, which I guess could be as short as 1 day, maybe a year, then medium term, and then long term. And so maturity, this is interest rate risk. Remember this, we'll have this conversation throughout the CFA program. Longer term bonds have greater interest rate risk, and we measure interest rate risk by the duration of the bond. So here's good stuff to know, not just for this LOS, but for lots and lots of LOSs in the future. that default risk is measured by Moody's and Standard & Poor's with their letter grading, or by credit default swaps. And then maturity is measured by duration. So this is how we can classify them. We can also classify fixed income markets by currency, by type of coupon, by geography. And this is a couple of pieces of material that we covered in that last reading. Let me just say one interesting thing about that type of coupon in the middle. Most bonds have a fixed coupon rate over their 10 or 20 or 30 years, but that doesn't mean that all bonds have to have fixed rate coupons. And some have a floating rate coupon. And let me just remind you that the coupon then floats up and then floats down. Here's a quick example of this floating rate of interest. So look on the left-hand side. If you have a swimming pool in which the water sometimes goes up and sometimes the water goes down, you have to ask yourself the question, okay, why is the water going up? Why is the water going down? Here, let's ask the relevant question, why are interest rates going up and interest rates going down? Well, we have to pick a certain interest rate. And that certain interest rate is known as the market reference rate, or just the reference rate. Now, historically, that reference rate has been the London Interbank Offered Rate. And I'm guessing that especially those of you who are in the financial services industry know that the LIBOR publication has met with some scrutiny and some scandal over the years. And so it is currently being replaced. In fact, it has been replaced for lots and lots of derivatives. And there are a number of reference rates, but the secured overnight financing rate, the SOFR rate, is probably one that's the most commonly used. I'm guessing on the exam that the Institute would not refer to LIBOR or SOFR. I'm guessing they'll just use the term reference rate or market reference rate. So we'll start with that thing, which, as the names of both of those suggest, is just an overnight rate from one bank to another. And so think of it as overnight loan, bank-to-bank loan. And so that's a super liquid interest rate that probably reflects current supply and demand conditions in the fixed income market. So we start with that one. And then notice there's a big plus sign in the middle, and we're going to add a spread. And that spread is going to be a number of basis points that reflect the default risk or the credit quality of the borrower. So we start with, boy, I don't really want to say this. Don't ever tell your finance professors that I said this. We want to start with something that's kind of nearly a risk-free overnight loan. Kind of nearly. I don't think that's a finance term, but you can think of it as, how about super low risk, an overnight loan, and then we add a level of default risk to it. So if James Johnson wants to issue floating rate debt and the reference rate is 3%, Johnson & Johnson has super low credit risk. So the floating rate might be the reference rate plus, 10 or 20 or 30 basis points. But if suppose I'm Jim's first aid Band-Aid company, then I have massive levels of credit risk. Well, if I wanted to issue a floating rate bond, then I would take, what did I say earlier, 3%, and maybe I would add 400 basis points, 600 basis points, 1,000 basis points, whatever it is. So this is important here, going back to that LOS, describe the use as reference rates in the floating rate debt. And so of course, floating rates are going to be higher for someone like Jim than for James Johnson. So look at the very bottom blocked point we have. The lower the issuee's credit quality, the higher its credit risk, and the higher the spread. That makes perfect sense. All right, so let's go ahead and distinguish between primary markets and secondary markets. Now, this LOS just asks us to look at the primary markets. This is what I tell my students all the time. The primary market is the market for newly created financial securities. So when James Johnson wakes up and says, hey, I'm going to issue $500 million in a fixed rate bond, in his mind, he is now creating that bond. And then that bond gets passed through the investment banker. So think of the primary market as a market in which the investment banking firm is super critical as kind of a conduit between James Johnson and then the bondholders throughout the world. Now, we can do this in a variety of ways. We can do it in an underwritten offer. And sometimes these things are best efforts. And what the best efforts means is not exactly what the name suggests. It kind of means that the investment banker is going to say to James Johnson and Johnson's, hey, you know what? You want to borrow $500 million. We'll do our best. We're going to put our best foot forward to find bondholders out there that are going to be willing to lend us, me, and then through me to you, this $500 million. So the investment banker kind of functions just only as a broker, getting all these people over there to part with their money to provide James Johnson. All right, so that and best efforts, boy, what happens if James Johnson wants to borrow $500 million and the investment banking firm can only raise $200 million or $400 million? And so that's what we have in parentheses down there in the middle. They may not raise the desired amount of funds. Now, of course, the investment banking firms, they use a best efforts if they don't want to take the risk. But skip up to the top teardrop point. There can be an investment bank guarantee. This is what James Johnson is going to get because Johnson & Johnson has been around for over 100 years, and they'll probably be around in 100 years from today, and maybe and probably even beyond that time period. But what the investment bank will do is they will say something like, you know what, we're going to guarantee that $500 million. In fact, we're going to ship that $500 million to you today so that you have access to that capital quickly. And then we have this whole series of clients out here, and we're pretty sure that we can raise the capital from them. And so the money flows really, really quickly from the bond holding public to the investment bank to James Johnson or the issuing company. So remember the difference between that best efforts and the guarantee. Now, of course, we can form a syndicate. And, I tell my students all the time, and I think I tell you guys, that you ought to read the Wall Street Journal every day. But back in the old days, when I was in graduate school, you'd open up the Wall Street Journal and there would be these big tombstones. And there would be a heading that says, Johnson & Johnson wants to issue $500 million worth of bonds. Here's the fixed coupon rate, 6.2%, 30 years. And then it was called a tombstone because it listed all of the different underwriters. And so there was a lead underwriter at the top, and then all of the syndicate investment banks underneath. Now, I still tell my students, and I'll still tell you, to read the Wall Street Journal every day, especially the editorial page, because those editors have a tremendous sense of humor. But you don't really see those syndicated offerings in the Wall Street Journal. Shelf registration, this is just a Securities and Exchange Commission rule that we need to make sure that the federal government here in the United States is aware that we're going to try to issue a bond, and then they release all that information to the public. Now, sometimes these bond issues can take the form of an auction where the bondholders, let's suppose you and I are all the bondholders, we can say to James Johnson, hey, you know what, we'll go ahead and I'll lend you $20,000, and one of you might say, I'll lend you $400,000, and one of you might say, I'll lend you $3 million, and you go ahead and you put in a bid. You'll say, hey, I'll do it at 4% or 6% or 8%. And so this is just like an auction that you see where the fast-talking men and women try to sell some old furniture from, mostly from those unfortunate people who have passed away. Now, the U.S. Treasury market, this typically takes the form of an auction. So this is a public auction, and you can do this, online. You can do it wherever you want, as long as it's public. But lots and lots of bond issues are privately placed. in which someone like me, what did I say my company's name was? Jim's Band-Aid Company. Maybe I can't get a guarantee. Maybe I can't do an auction. But maybe there's a mutual fund out there or a hedge fund out there that wants to take a chance on me. And so I can issue a bond. These are non-underwritten, right? So that the investment banking firm doesn't take any risk. And they privately place it over there to Ed's mutual fund. And Ed then holds on to my bonds, and I pay Ed the coupon, and then I pay Ed the principal payment at maturity. And that private placement doesn't have to be with just Ed. It could be Ed, and it could be Betty, and it could be somebody else out there. So think of primary markets as the market in which financial securities are created. And the created means that this is the first contact between the bondholders and the issuing entity, whether it's a corporation or a government. So let's go back to my example. Let's suppose, what did I say? I was going to lend James Johnson, I can't remember what I said, $25,000 for me. And one of you did $1 million, one of you did $3 million, or whatever those numbers are. So let's suppose that we lend James Johnson that capital today, and we receive the semi-annual or the annual coupon payments for 2 or 5 or 8 years. Let's suppose this is a 30-year bond. And then after some time period, we say something like, hey, you know what? I want to sell my bonds and I want to use the proceeds to build a swimming pool in my backyard. So what do? We pick up the phone and we call James Johnson and say, do you remember me? I was that kind enough person to lend you that money 5 years ago. James Johnson's going to say, what are you talking about? I already used that capital to invest in my first aid kits. Go somewhere else to get your money. Well, that go somewhere else is the secondary market. Now, of course, the most famous secondary market of all time is the New York Stock Exchange. But since we're talking about secondary markets for bonds, we can go to 2 different places. We can go to organized exchanges and we can go to the electronic market. Now, all markets are electronic these days, but the over-the-counter market was kind of the first electronic market. And so these are secondary markets. Notice that first embedded bullet point. Existing securities are traded among investors. And so I always tell my students, I say, think of the New York Stock Exchange as the market for, and I don't like doing this, but I'll do it here, quote, used securities. Used simply meaning that they have already passed through the investment banker's hands and the capital has already been used for its intended purpose. Now, of course, the second point there, major players includes, what did I say earlier, pension funds or mutual funds or hedge funds. And then you can't ever forget about national or central banks. Now, here's the vision that I give my students on the floor of the New York Stock Exchange. And, by the way, I've taken my students to New York City to see the exchange multiple times over the years. And, they say, hey, you know what, Jim, that was really a good idea. Because they can visualize that when now it used to be called a specialist, now it's called a designated market maker on the floor of the exchange. They say pretty much, here, there are 2 lines. If you want to buy in this line, if you want to sell, get in this line. And these are bid and ask prices. So bid and ask, bid prices will always be less than ask price. And what the reading suggests, and this is really, really cool stuff, the spread between the bid and the ask price is an indication of liquidity. So Johnson & Johnson probably has a bid-ask spread that's super narrow, but Jim's Band-Aid Company, if I could trade on the floor of the New York Stock Exchange, would have a much wider bid-ask spread. Now, of course, you can take that visualization from the floor of the New York Stock Exchange and trade it over to the bond exchange, whether that's organized or over the counter, and you can at least understand that there are 2 markets, the buying market and the selling market. Now, of course, bid and ask prices for bonds are much wider than they are for shares of stock because there's not nearly the liquidity in the bond market as there is in the stock market. I think we did this LOS, at least a similar one in the previous reading. Sovereign bonds, these are issued by national or federal governments. Here in the United States, the federal government issues treasury bills, which are discount securities that have maturities of less than 1 year, treasury notes, which are between 1 and 10 years, and then treasury bonds, which are longer than 10 years, although most treasury bonds are issued in 30-year increments. And by the way, back when I was in graduate school in, let's say, 1990, the Treasury Department issued these securities weekly. They issued treasury bills weekly and notes and bonds monthly. Nowadays, I mean, think about it. We have $30 trillion in 2022 of treasury securities. So they're doing these constantly. In fact, I did go recently to a source that said it was the schedule for 2022. And the Treasury Department plans on doing this on Mondays and Tuesdays, Wednesdays, and Thursdays. I couldn't find any Fridays, but so the Treasury is borrowing money. Just think about it, almost every day. That has nothing to do with the LOS, but that's another piece of information that I have up here that probably has no value to any of us during the course of our lifetime. Here we go. Sovereign bonds are usually unsecured, and they're backed by the taxing authority and the national authority. Of course, that makes perfect sense, right? Types of sovereign bonds, fixed rate. Most of them are fixed, but they can be floating rate. But going back to at least 20 or 30 years, I think the Treasury Department started issuing inflation-linked bonds back in the 1990s, and so these things just have a coupon rate that is a function of inflation. So if inflation rate goes up, then your coupon rate goes up as well. All right, other types of issues. The reading refers to these as non-sovereign bonds. I always refer to them in my class as municipal bonds or local bonds. So notice what we have in bolded over there: provinces, regions, states, cities, townships, boroughs. I mean, any taxing authority probably has a budget deficit, and they want to finance their budget deficit by issuing a bond. Now, one thing here, I'm going to go back here just really quickly. It's well accepted, well documented that most professionals and most academics, they perceive these treasury securities to be default risk-free. That doesn't mean that these non-sovereign bonds are default risk-free as well. Now, this might not relate to this LOS here, but sooner or later you're going to get this in the CFA program, that there are non-sovereign bonds that have defaulted over the years. So these have default risk, and they will be rated by Moody's and Standard & Poor's and Fitch. So what are their purposes here? Schools, hospitals, motorways, bridges, airports. Yeah, so how do they repay these taxing authority? And by the way, I love asking these kind of questions to my students. I always say, what are these bonds issued for and how are they repaid? So that's probably good advice for the exam. Quasi-government bonds, just skip down to the bottom there and you'll know exactly what these are. You have the Federal National Mortgage Association. You have the Student Loan Marketing Association, Sallie Mae and Fannie Mae. There's a Ginnie Mae. There's a Freddie Mac. There are all sorts of these quasi-government bonds. Now, let's go ahead and ask the important question. If Treasury bonds are considered to be risk-free and non-sovereign bonds are considered to be non-risk-free, what about quasi-government bonds? They kind of float somewhere in the middle. And the answer is, well, they shouldn't be risk-free. Let's go ahead. Whoops, I need to come to this one. Let's go ahead and do Sallie Mae. Let's do the student loan. These bonds, they ought to reflect the credit risk of all the students out there who've gone to college and studied and graduated, right? And now they're working, or at least they're supposed to be working, to repay their student loans. These bonds ought to be reflective of the credit risk in the student loan market. But look in the middle paragraph there. But investors often perceive an implicit guarantee because these quasi-government organizations, they're federal organizations. So I guess most bondholders kind of believe that there's an implicit guarantee. I'll let you guys determine whether or not you think they're risk-free or not. And then how about supra? This means that we take some national organizations, maybe they're government related, maybe they're not. And these entities, they issue bonds as well. Notice World Bank, IMF, you probably heard of those. There's the Asian Development Bank. There's my favorite one, the African Development Bank. The reading suggests that these are generally plain vanilla bonds, and most of them are, but they don't have to be. I encourage you to go to Asian Development Bank webpage and the African Development Bank webpage and see all of the bond issues that they have outstanding. And pretty much what they do is they issue a bond and they take the proceeds and they make loans to those entrepreneurs who have ideas to benefit that particular geographic area or that particular client base. Corporate debt, this is a big topic throughout the CFA program. And so what do we know? On the right-hand side of a corporation's balance sheet, they issue bonds all the time. So let's go ahead and be more specific here about what types of bonds. So look up in the top right in the green. So those are the corporate notes and bonds. Now remember, notes are typically 5 or 10 years. Bonds are 30 years or 40 years. And by the way, there are corporations out there like Walt Disney and Coca-Cola who've issued 100-year bonds. So there's nothing really interesting about the 30-year convention. And so when we get to level 2 and we talk about Modigliani and Miller and capital structure, our focus will probably be in that green box up there on the right. But this reading then adds a couple of other elements to it. And so let's go ahead and go through these elements here. So a bilateral loan, this is just a loan from one bank, probably a bank or financial institution, to the borrower. Notice what we have in the second bullet point there, probably small and medium-sized companies, right? Jim's Band-Aid company would probably have to go to a bilateral loan or maybe a syndicated loan in which there are a handful of banks that would get together and lend me some capital. Now, when we do this in the short term, we can do this officially with something called commercial paper. And commercial paper is usually issued, excuse me, in fact, I'm going to say almost exclusively issued by large corporations who are managing their working capital. So notice that first bullet point, short term, that's super important. Back here, let me just go here real quickly. All right, so that bilateral loan and the syndicated loan, these are long-term. And of course, corporate notes and bonds, those are long-term. Although, these bilateral loans and maybe some of the syndicate loans, they could probably be short-term if we really wanted them to be. But commercial paper there down in the bottom left purple, this is definitely short-term. And what did I just say earlier? And what does that third bullet point say? It's a source of funding for working capital and seasonal demands for cash. So a company like Johnson & Johnson can get away with saying something like, oh, I'm going to issue commercial paper today for $1 billion and it's going to be 30-day maturity. And so it's going to be a discount security. So Johnson & Johnson borrows a whole bunch of money today and it uses for working capital needs, right? Things like accounts receivable and accounts payable and notes receivable and notes payable and, all that stuff that shows up on the top of the balance sheet. And then what happens? Well, then James Johnson sells a whole bunch of first aid kits, and vaccines and all the stuff that Johnson & Johnson does. And so it'll have, what did I say, 40 mil or $1 billion. So then it just uses a cash flow to repay. Notice the bottom there. Yeah, financial institutions do this all the time. And so notice these are large financial institutions. All right, corporate notes and bonds. I bet we've done this before, right? So debt instruments, these can be issued by public or private companies. They can be privately placed or sold in the public markets. They can have ranges of maturity from 1 to 30 years, comma, the reading doesn't mention this, but could be 100 years, could be 1,000 years. I mean, there's really nothing preventing these companies from picking some big number up there. Coupon rates can be fixed or floating. We said that before. The floating rate could be so floated that it's 0, or the fixed rate could be 0%. This is called a zero coupon bond. But then there are these really, really cool bonds that are known as payment in kind bonds. I think we talked about this in the previous reading. These are coupon payments that are not made in cash, but are made in terms of additional bonds. The maturity date can be fixed, so this bond could mature in 30 years, or it can have serial maturity, and it could have a sinking fund, and they could say something like, look, let's suppose it's a $1 billion bond, and it's 30 years. The serial maturity structure could say something like, all right, we're gonna retire a third of it in year 26, and a fifth of it in year 28, and a seventh of it in year 29, and then the rest of it, I'm not smart enough or quick enough in math to do all those to see how much exactly is left over in that final year. Of course, we had a great conversation in that last reading on security, whether these are unsecured debentures or if they're backed by collateral. Remember, we talked about a collateral with an equipment trust bond. You remember I used the example of the Pink Panther diamond. Yeah, most of these are traded over the counter. Some have contingency provisions. I'm going to give you a quick quiz. Do you remember in that previous recording, what do I and many academics call these contingency provisions? We call them embedded options. And they can be callable, they can be puttable, and they can be convertible. How about structured products? So this is a product, which is a fixed income security that is structured. Structured meaning that you can throw anything that you want in there. I mean, I could be Jim's Band-Aid company, and I could say, look, I'm going to borrow a bunch of money today, and a year from now, I'll pay you a 5% coupon, right? Just regular traditional coupon. And then in year 2, I could pay you a 7% coupon. Maybe it steps up, right? And then in year 3, I could pay you in a barrel of oil. Oh boy, so what would you hope? You would hope that the price of a barrel of oil would go to $300 or $400. That would give you protection against inflation in the energy industry. And then in year 4, I could say something like, hey, I'm going to pay you the dividend yield on the S&P 500 index. And then in year 5, I could pay you the future market value of the latest James Bond movie in terms of ticket sales, or. So that's a structured product. So let's get back to reality here. What's the reading definition, right? The prepackaged investment based on a single security, a basket of securities, options, commodity, all this other stuff that we can throw in there. Now, of course, the easiest in all of these structured products is a mortgage-backed security or an asset-backed security or a collateralized debt obligation. And remember, these things can be pretty simple, like mortgage-backed security in its simplest form is really just a matter of us as bondholders buying into a package of mortgages. But lots of these are divided into what are called slices or tranches. And so that's that middle point there. They repackage and redistribute risks. So these tranches, maybe there's 4 tranches in a mortgage-backed security. And so the bondholder can buy into whichever tranche that they like, repackage and redistribute. We'll talk at length about this in level 2. You can have these things called capital protected instruments where there is a guaranteed repayment of principal, but then there's an opportunity to share in profitability. Let's do a quick example here. Let's suppose we have an investor with $100,000, and this investor can buy this zero coupon bond that has a maturity of $100,000 for its discounted value of just $99,000 today. So that means there's $1,000 left over, so to speak. Let's suppose that investor buys a call option. And so this call option gives the owner the right, but not the obligation, to buy an underlying instrument here. And that underlying instrument could be almost anything. It could be a bond, it could be a share of stock, it could be a barrel of oil, it could be returns on a James Bond movie. But the point is, when you buy a call option, you benefit when the price of the underlying instrument increases. So you get the sense that the only way the price of that underlying instrument is going to increase is if the profitability of the entity that is determining the value of that underlying instrument goes up. So here's just a super quick illustration here. So today, what can we do? We buy $99,000 worth of a zero coupon bond. We buy a call option for $1,000. So what do we get? At maturity, we get the $100,000. for the zero coupon bond, but for the call option, it depends on what happens to the underlying asset, right? I mean, suppose the underlying asset value falls to zero, well, then we lose the maximum of that $1,000. But suppose it goes up to $10,000 or $20,000 or $1 million, well, then we can have unlimited upside potential. So you see how this kind of looks like a bond. It has a part bond, right? It has the zero coupon bond, but it is layered, structured with a call option, and so that the future cash flows are changed. So this is called a capital protected instrument because we're protecting our $100,000. But if things go our way, then we might get something in return. Maybe we get $105,000 a year from now or $110,000. Maybe we'll just get $99,000, but that's the minimum that we get. Of course, this has to be a risk-free zero coupon bond. And so I'm just going to go back here to this structured product here, that first bullet point. And this is probably not too relevant for this particular LOS and this particular question on the exam, but it's going to lead us to a greater understanding when we get to level 2 and level 3 of what financial institutions can do with these structured products. They can create a structured product to meet almost anybody's needs. You know, in the academic world, we call that spanning. We like to span all of the future values, and we want to know exactly, and we want to have as many, and we want to see what are all of those possibilities, and structured products allow us to get there, and to get there in a pretty efficient way. A couple other structured products, yield enhancement. What we can do is we can say something like, oh, you know what? If something happens in the future, then your yield will be enhanced. I mean, really, people in financial institutions sometimes are clever when they come up with these names, but sometimes it's just an obvious notion. So let's look at this, a credit-linked note. So what we could do is issue a bond, let's call it a note in this example, in which we have fixed coupon payments. So you get 5% or 10%, whatever it is. But remember that at the end, that most bonds mature for $1,000. But suppose that we structure this product to say something like, hey, suppose that something really good happens, or suppose that something really bad happens, that $1,000, maybe it'll be $1,100, or maybe it'll be $900, or maybe it'll be something. And what do we have here in the arrow point? The occurrence of a well-defined credit event, such as a rating downgrade, or a default on the underlying asset called the reference asset. And so you can buy these yield enhancement instruments if you're worried about things like default or rating downgrade. And by the way, you could do this, and here I'm making this during the NBA playoffs, this recording, and you could put together a yield enhancement instrument that says something like, all right, we'll pay a fixed coupon rate, and then if Steph Curry makes 100 threes in the NBA Finals, then you pay off by this much. If he makes less than 100 threes, then you pay off by this much. So my point here in telling you these stories is, don't let your mind be limited to what you read in all of these different readings, because these are really, really cool stuff. This is why we call it financial engineering. How about a participation instrument? This is exactly what the name suggests, that, suppose that the underlying asset, like a share stock or a company's operating cash flows, or, it could be government's tax revenues. Suppose this thing, just swells and swells and swells. And so the floating rate bond will have a floating rate that's tied not to LIBOR or SOFR, like we talked about a few minutes ago, but maybe it's tied to operating cash flows, or maybe it's tied to Steph Curry's number of threes. How about some of these structured products that are known as leveraged instruments? What did we say earlier? We said something like, we like these floating rate instruments because they tend to increase the coupon rate if things go well, if things move in our direction, whether it's the underlying reference rate or cash flows like we just said. But what about those who would like to benefit if interest rates fall? Well, let's do an inverse floater. And so when interest rates fall, then the coupon rate on this leverage structure product goes up. And how about sources of funds for banks? I'm guessing that you guys probably know this. All we're doing is looking at the right-hand side of a financial institution's balance sheet, and what shows up there: customer deposits, right? This is all those retail banks, but the wholesale, what do you have? You have, certificates of deposits. You have interbank funds, because remember, there's huge bank-to-bank lending. You have reserve funds with the central bank or some other huge bank out there, and repurchase agreements. And so banks have sources of funds. Now these things here tend to be in the short term, and so of course banks can issue notes, and they can issue bonds, and they can issue commercial paper. Let's go ahead and look at this final LOS on repurchase agreements. Once again, we'll have to describe repurchase agreements. And let me give you just a quick, simple example. Those of you who watch my videos know how much I love my financial calculator. So let's suppose this financial calculator is sitting on my desk and I don't need it. I don't need it today or tomorrow or maybe for the next couple of days. But you need it because you need to take the CFA Level I exam tomorrow or in 2 days. And so you and I have a desire to transact. How about if I say to you, hey, look, you can borrow my financial calculator, and you can borrow it for a day or two, but I want it back. And so we could just shake hands, and you could say, all right, Jim, when I'm done the test, I'll drop it off at your house. But let's make it more formal. Let's suppose that we sign a contract, a repurchase agreement. And so I say something like, look, you're going to have this calculator. Why don't you just pay me its current price? Let's call that the spot price of a calculator. Let's suppose it's $100. So you pay me $100 when you borrow this financial calculator, and you use it, and man, this calculator works so well, and you answer all the questions on the exam correctly. And then a day or two later, you show up at my front door, and I had agreed to buy it back from you for $105. Let's just pick a number, right? So this is a repurchase agreement. And so, I'm just looking to get rid of my calculator for a couple days and to help you out. Now, I lend this to you, and I agree to buy it back from you for $105. But now I have your $100. What am I going to do with that? Let's just suppose, for some crazy sake, that I take that $100 and I go to Las Vegas and I bet it on the red, and it wins. And so now I have $200. So when we trade for $105 in a day or two, I'm super happy, right? Because I used your money, and I went out and I bought, I won $100. So I take my $100 profit and I give you back your $100, plus I take $5 of it and I give you our agreed upon price. So you have $105. So you were happy, right? You got the use of my financial calculator. You bought it at 100 and you sold it at 105. You're super happy, but I'm super happy because I used your money. So look at that second teardrop point. Can be viewed as a collateralized loan. All right, so let's think of it a little bit in a different example. Now, let's get rid of this financial calculator because, of course, there's no repurchase agreement based on that financial calculator, least of which my financial calculator, which is probably 30 years old. But let's suppose that it's a share of stock. And so let's suppose that share of stock sells for $100 today. So I have this share of stock. I hand you the share of stock. You hand me $100. So what are you going to do with that share of stock? Well, I don't know. You could do whatever it is that you want with it. But what am I going to do with that $100? I'm going to take that $100 and I'm going to invest it somewhere else. Now, if I agree to repay you, if I agree to repurchase that share of stock for $105, then I expect the value of this share of stock to be $106 or $110. So notice that this is a bet. Now, of course, a repurchase agreement is not going to be written on a financial calculator. It's not going to be written on a share of stock, but it's going to be written on a bond. And it's probably going to be written on a risk-free bond, like a treasury bond or a treasury note or a treasury bill. And so essentially, this is really a collateralized loan because what I'm doing is that I have this calculator, I have this share of stock, and I have this bond, right? Let's just go and use the bond. So what do? I sell it to you and agree to repurchase it from you. Huh. So each of us is exposed to counterparty risk because a day or two from now, I might not be able to find you. A day or two from now, you may not be able to find me to complete the repurchase part of this transaction. So we're exposed to counterparty risk regardless of the collateral. And so what happens here? We have this repo margin. A lot of people call it a haircut. And this is just really the difference between the market value of the security used as collateral and the value of the loan. So think about this. We know from last reading, we're going to know this intimately from our next reading, that as yields go up, the price of the bond goes down. And so this repurchase market is really essentially a bet between you and me on the movement of interest rates. If interest rates go up, the price of that Treasury security is going to go down. And so what has to happen? So I hand you this Treasury bill and you hand me $100 and I agree to repurchase it for, let's say $102. Well, what am I going to do? I have your $100, so I'm going to go out and invest it. Boy, I'm going to invest it. Am I really going to go to Las Vegas and play the red? Probably not. Am I going to buy a share of stock? Probably not. Am I going to buy some other kind of a bond? Well, probably. And so what am I doing? I'm hoping that I buy that bond today, and I'm hoping that the interest rates move in my direction, right? So that when I go to settle this repurchase agreement with you tomorrow, that I make money off of it, right? I profit because the value is different, and that's that repo margin. Now, of course, there's all sorts of margin levels out there in these agreements, and this is not really going to occur between you and me. It's going to occur, through some financial intermediary, like a financial institution, and so they're going to probably standardize length of the agreement, 1 day or 1 week, the quality of collateral. Is it going to be the actual bond? Is it going to be, well, let me throw back my Pink Panther Diamond example in there. Is it going to be over collateralized? Credit worthiness of the counterparty, and then supply and demand for the collateral. This is a great conversation we're going to have in level 2. And that takes us through these learning outcome statements, which ask us to describe. So remember, you're going to have to explain all of these statements here. So think about each one of these as building blocks of our foundation that we began with the previous reading. We've laid this brickwork now. Now we have a much more solid foundation. What we're going to do in the next reading is get out our financial calculator. I'll probably show it to you again. Get out our financial calculator and compute the price of a bond and the yield to maturity on a bond. That'll be super fun stuff. But for now, we're going to ignore the financial calculator. So I encourage you to go to the actual CFA reading. There are, I believe, 30 end of reading questions, and these are relatively simple. In fact, I'm willing to take a gamble here that if you paid attention during this reading and you went and you answered or tried to answer those 30 questions, I'm guessing that you would get, oh man, you got to do at least a B plus on it, or maybe an A. So couple those end of readings, and I think they're pretty straightforward with what we have, and we provide you with practice questions. And then, I say this pretty regularly. Maybe I ought to say it in more end of recording comments. Is I know that the candidates are tempted to go take the mock exams. And I know, so just resist that temptation. Work through each of the chapters first. This was fun for me. I hope it was for you. So thank you for watching. Have a great day and good luck studying.